Hello and welcome to the Q1 2025 review. We just wrapped up the first quarter of 2025, and it's safe to say markets had an interesting start to the year. But I wanted to take a minute to explain something that gets tossed around a lot in the media, the VIX, sometimes called the fear index. But what is it and how does it work? Well, the VIX tracks how much volatility investors expect in the stock market, specifically the S&P 500, over the next 30 days. It does this by looking at options pricing. Here's an easy way to think about it. Imagine you're buying insurance for your investment in the stock market, just like you'd insure your car or your home. Investors can buy options to protect themselves from big drops in the market. These options are kind of like insurance policies. They cost more when risk is higher. When more investors are worried and buying that insurance, the cost goes up, and the VIX looks at that price change. So a high VIX doesn't mean that the markets will crash. It just means that a lot of investors are bracing for big moves. And a low one means that most people expect things to stay calm. So what happened in the first quarter? Well, Canada was up 1.5%. The US was down almost 5%, and international markets were up about 6.5%. We know that since then, things have dropped. As of this morning, the TSX was down 7% and up 3.6%-ish over the past year. The US was down 12% and was flat over the last year, and international was down about 4% over the last year. So why are markets all over the place? Well, you've seen the news. It's because we don't know what's going to happen. How will global tariffs affect the global supply chain? How quickly will companies adjust? How quickly can they even create new supply chains? Will they do it in the first place, or will they just increase the price and things will stay there? Will this increase the speed of innovation, bring production but not jobs back to the US? There are just so many unknowns, and it's the not knowing part that causes all the yo-yoing in the short term. If this makes you nervous, though, let's zoom out and let's look at Canada's history. You will see that downs in the market is normal. The biggest difference here, though, is that this drop is a direct result from an individual's actions. And this actually gives me more confidence that the eventual outcome will be a recovery, just like it has always been in the past, 100% of the time. So, we don't panic. We don't chase headlines. We stay diversified, stay invested, and stick to the plan. A good plan already expects markets to have years like this. It's not about avoiding every dip. It's about getting where we want to go in spite of the dips. And what is a core principle in doing this? As I always preach, invest to the right time frame. So, if these drops or the news has left you feeling uncertain, that is totally normal. But I want to remind you, long-term investing has always rewarded patience, not panic. So if you're worried or you just want to talk through things, please feel free to reach out. I'm here to help. Thanks for watching, and I'll see you in the next one.